The Canadian dollar right now at 74.79 against the U.S. dollar, and we want to get a little bit more insight into this decision. Joining us here in studio is Frances Donald, Chief Economist at Manulife Investment Management. Frances, thanks for being here. What's your immediate reaction to the Bank of Canada's move?
We are in extraordinary times. We are living through history that will end up in textbooks and case studies as we analyze central bank policy, how effective it is, how quickly central banks should be reacting, and whether or not we look back and say they acted too late, too early, or right on time. 50 basis points is a very strong message from the Bank of Canada. They are clearly concerned about downside risks, but I suspect that this is in conjunction with globally coordinated rate cuts. The Reserve Bank of Australia, the Federal Reserve has cut. We will continue to see global central banks preemptively react to the downside risks created by the coronavirus and what it will do to economic growth this year.
For those just joining us, the Bank of Canada has just cut half a percentage point from its benchmark interest rate, easing monetary policy in this country for the first time in more than 4 years. And as Frances noted, following the action by the U.S. Federal Reserve yesterday, Frances, I have to ask you, we're always wondering what kind of conversations these central bankers are having behind the scenes and whether or not the Fed's move yesterday was the kind that just ultimately forced the Bank of Canada's hand, even if perhaps they didn't want to cut by 50 basis points, because there was some chatter in the marketplace that perhaps they didn't want to go this far.
I hope we find out one day what happened on that G7 call with the finance ministers and the central banks, because what we were anticipating is something like we saw during the financial crisis, which is they all meet and then a statement is released after the fact in which everybody responds with their own tools. What we saw instead was about a 2-hour delay between the statement, which didn't have concrete specifics, the Federal Reserve cutting interest rates. We have the Bank of Canada cutting today. We have the ECB coming up on the 12th. And then, of course, we have the Fed again on the 18th. So I suspect the call was we all need to move, but we also need to move relative to where our economies are. What's interesting here is that Canada will benefit pretty significantly from the Federal Reserve cut by itself. We import a lot of our bond market moves from the United States, and the Fed is really central banker to the world. The Fed is the central banker that will calm financial markets, not the Bank of Canada. So we are getting in, I would say, effectively with the Fed and the 50 basis point cut, even additional easing here.
I just want to go into some more detail on and for those just joining us, the Bank of Canada cutting interest rates by 50 basis points, basically following the action we saw in that emergency cut by the U.S. Federal Reserve yesterday to 1.25%. Frances, there is a paragraph here dedicated to coronavirus, and I'm just going to read it verbatim. COVID-19 represents a significant health threat to people in a growing number of countries. In consequence, business activity in some regions has fallen sharply and supply chains have been disrupted. This has pulled down commodity prices and the Canadian dollar has depreciated. Global markets are reacting to the spread of the virus by repricing risk across a broad set of assets, making financial conditions less accommodative. It is likely that as the virus spreads, business and consumer confidence will deteriorate, further depressing activity. Do you have any general thoughts on how the Bank of Canada is characterizing coronavirus compared to what we have heard from other officials, central bank officials or other officials this week?
They are characterizing it appropriately, which is that the central banks may not be trying to lift the stock market. That's not the goal. The goal is to recognize that what we've witnessed in the past 2 to 3 weeks has economic implications. So do rate cuts help cure a health crisis? Absolutely not. Do they help cushion the economic impact? Yes. And if you're a central banker, you have one tool, arguably a couple small tools that do the same thing. Would you stand on the sidelines when you know people are going to be afraid, suffering, and pulling back? No, you would use the tool that you have in your pocket. So this, to me, we can debate whether it should have been 25 or 50, but central banks need to be moving in this particular environment.
And as investors look to the bond market, we can see, we're showing it on our screen, this 10-year bond yield, which has steadily been moving lower. Same story for the 5-year 10-year yield of late. The other part of this story is that Canada's had a few hiccups of late. We know that. We've talked a lot about the rail blockades, other issues that the Canadian economy has been grappling with. The Bank of Canada, in their statement, they do leave some time to talk about that, and I'm going to talk a little bit about it as well. This is a verbate quote. It is becoming clear the first quarter of 2020 will be weaker than what the bank had expected. They go on to say that business investment does not appear to be recovering as was expected following positive trade policy developments. That clearly is a comment on the U.S. and China trying to find a common ground on trade and, of course, getting that new NAFTA deal arranged. What they say are the rail line blockades, the strikes by Ontario teachers, winter storms in some regions. These are dampening economic activity in the first quarter. Against that backdrop, I ask you the question, if we hadn't been dealing with those things here in Canada as well, do you think perhaps the Bank of Canada would have thought differently about, say, 25 basis points versus 50 basis points?
There was always justification to be cutting rates at this meeting, even if it wasn't including my own base case before coronavirus. We were already looking at an economic environment that looks worse heading out over the next 12 months. The so-called output gap, the measure of where the economy is, where it could be, was getting worse. And we know that central bank policy has to react with 12 to 18 months in advance of where they think the economy is going to be. So there was already signs that we could see a 25 basis point cut here. I suspect that they were leaning towards that direction, and because we are looking at a global coordinated rate cut, a significant move towards easing globally, they were pushed towards 50. I'll also say that most central bank research will tell you the closer you get to zero, counterintuitively, the bigger and faster you have to go. You cannot afford to drip monetary policy in. If you want to avoid having to cut more, you cut faster in bigger chunks in the beginning. This is all central banks will be operating this way. So even if we were experiencing the same shock, these same economic conditions 20 years ago when interest rates are higher, we may not have seen 50 basis points today. There is a lot flowing into this decision. It is not simply Corona. It is not simply Q1. There is an entire framework that needs to be readjusted in this environment.
Well, that is helpful context on why they decided to go big. And just to reiterate, the Bank of Canada cutting its overnight rate to 1.25%, saying their governing council stands ready to adjust monetary policy even further if required, specifically on coronavirus or COVID-19, as they describe it. It is a material negative shock to Canadian and global economies. As a result, that's this monetary plan. Fiscal authorities are also obviously responding to this. The Bank of Canada is saying in their statement, and perhaps in the days ahead, we'll hear more on what Canada's response on the fiscal side could be. I do wonder, though, Francis, we had a poll question ahead of this decision today, where overnight, a lot of our BNN Bloomberg viewers, and this is not a scientific poll, felt the Bank of Canada should stay on hold. I wonder if those are homeowners who are wondering about what this kind of action means for things like household debt and the heat surrounding the housing market, which is one of the reasons why before all this unfolded, the Bank of Canada was cautious when it came to cutting rates.
So the Bank of Canada will look at this environment and say, we can have short-term pain in housing markets for long-term gain. They are constantly thinking, how do we keep inflation, price pressures, and probably growth stable over a longer period of time? They will sacrifice financial imbalances, which will get worse in this environment, to avoid, I would say, probably recession risks. So that is the handoff now. We needed to get to a situation where the benefits of cutting outweighed the costs. Until coronavirus arrived, I don't think we were quite there. So yes, this is the sacrifice that the Canadian economy will make with rate cuts. We will try to prevent downsides to growth. We will try. I suspect this is aimed towards preventing job losses and companies shutting down, and we will take it on the chin when it comes to housing activity as a result. I think when you put it in that context, almost every economist would agree right now that is the sacrifice we need to make.
All right, Fran.